Hello and welcome to the Westpac macro video. I'm Sean Callow, and joining me today, also in lockdown in Sydney, is senior economist Matthew Hassan. Welcome, Matt. Well, we are in lockdown, as I note, that we'll be talking about the implications for that in terms of Australia's economy. But first up, a reasonably busy data week, certainly in terms of the markets you focus on in particular, Matt. So the house price index for June. What did we see from the key indicator there, the key report in terms of the rebounding housing market?
Yeah, very much more of the same. Another very strong rise, 1.9% for the June month. That's lifted its annual price growth to 12.4%. Particularly strong month in Sydney, up 2.6%. Incredibly, Sydney prices are up over 10% in the first half of the year. That's close to our full calendar year target for price gains of about 16%. There have been some suggestions that month to month we've seen some moderation in price growth momentum. I think that's a little bit debatable, but mainly that comes back to this incredible gain that we saw in the March month, the 2.8% rise. That was a 32-year high at the time. We were never going to sustain price gains at that pace. Now, I think outside of that particular monthly blip, the pace is pretty much similar, running at a strong double-digit annual pace. Where there are more convincing signs of a moderation is in the Perth market, where there does look to be some rebalancing between listing demand and price growth starting to flatten out. But elsewhere, it's still full steam ahead. Some particularly impressive gains happening at the top end of the Sydney market. Houses again outperforming units, and Hobart, Tasmania across the board is very strong. But overall, we've still got a pretty impressive price burn going on in Australia.
Okay, and in terms of the broader economy, as I keep complaining, we're in lockdown in Sydney, and the economic impact very mixed. Obviously, terrible for tourism, but there can be some offsets elsewhere. So, how are you tracking this in terms of your forecasts and adjustments you might have to make?
So right now, obviously, we're watching the situation very closely. It's still a day-to-day proposition. We have an expectation of a minimum 14-day lockdown in New South Wales, identical to what we saw in Victoria back in June. It will clearly take the edge off activity for the June quarter, and particularly for July, is moving more into the third quarter. In terms of the data flow so far, we don't really have anything to hand on actual activity. What we do have is measures of mobility. So Apple and Google both produce measures, daily measures of the based on search activity and cell phone movement. They're showing already that in New South Wales in particular, we've seen a steep drop off in movement as you expect in a fairly hard lockdown, similar to what we saw in Melbourne a few weeks ago. The big question, of course, is how long this lasts. There is a secondary question. We track, the timely data we have around the economy is our card tracker updates, where we get weekly figures on consumer-related card activity. We have data up to the 26th, so just on the cusp of going into lockdown. That did show that the partial measures across parts of cities and the suburbs do look to have had some slight impact just prior to the hard lockdown across the broader metro region. Next week's update will have figures for July 3. That'll really capture both the Sydney lockdown and the lockdowns in Perth and Brisbane and Darwin. If we see a similar scale of cleaning effects that we saw in Melbourne's recent lockdown, that'll probably knock the headline index by 5.5% to 6%. Likely to take us for 11 months. So one thing to bear in mind here, there's a very high coverage of measures at the moment. It's not just one state that's going into restrictions. It's roughly about 40% of the population is now experiencing some form of lockdown. One other thing, though, we have seen consumers adapt over the course of COVID. One of the things we looked at in the latest card tracker report is the correlation between these mobility measures and card activity. And in the initial phases of the pandemic, through the second quarter last year, the correlation was very tight. Mobility dropped, spending dropped, it all happened almost one for one. But as the pandemic has unfolded, subsequent lockdown measures have hit mobility hard, but spending not quite as hard. So I think that speaks to the way consumers are adapting to the COVID environment. I think also they're becoming less fearful. That initial national lockdown was pretty scary back in April, May last year. I think subsequent measures, while that definitely rattled confidence and cast doubt on our ability to continue containing the virus, they haven't been quite as shattering as the initial lockdown last year. But also I think we've been adapting in terms of purchasing via online, becoming more efficient with our movements, so shorter trips, fewer trips, but doing the similar amount of spending. And so again, I think that cautions against sort of jumping too far off for lockdown measures, especially if we do roll this out, if we do roll out of this in 14 days, that's good, then something similar to previous mini lockdowns, a bit more extended. We saw it in Melbourne, it was like a 2-week mini lockdown rather than 1 week. That could be quite mild. So I think, long story short, we're really still waiting to see how this particular outbreak unfolds. There's really no way for us to tell how long or how whether we need to we'll be able to ease restrictions or whether they may be tightened further. There's a lot of moving parts, and I think the card tracker in the next couple of weeks is going to be a really important gauge of how much of a shock we're about to see.
Yeah, that is a fantastic report, the card tracker. So I would certainly recommend everyone look out for that every week. Very timely and very broad-based. And finally, Matt, the RBA obviously dominating the local economic calendar in the week ahead. On Tuesday, the decision on policy settings and I don't know if it'd be a press conference, but certainly remarks from the governor. So clearly that is not what normally happens at the meeting, and it highlights the importance there. So, but what is Westpac looking for from the meeting, which is so keenly anticipated?
Look, we think there'll be a few changes. The first, obviously the developments around the labour market have surprised to the upside. The fall in the unemployment rate in particular has come through faster and larger than it has expected. And there'll be some need to evolve policy to back to that. So I think the main messages, though, will be around the shift to a flexible approach to QE rather than setting an ultimate purchase target. It'll be a monthly purchase target, and that'll give the RBA more flexibility to adjust according to developments abroad and locally. I think though, the press conference is going to be a pretty important message setting. I think the RBA, while they are going to be a little bit more confident about the economy's prospects, this renewed lockdown, particularly in Sydney, is going to cast more doubt over exactly how well that recovery is sustained. And I think they'll want to emphasise that the changes they're making in terms of their outlook and we don't think they'll extend the 3-year target to the November 24 bond, for example. I think they're going to look to try and balance that against the view that this is still a very stimulatory policy. It's not a policy tightening from the wider point of view, and they'll continue to maintain extraordinary stimulus until the recovery is secured. So I think it'll be a really interesting one to listen to, how they finesse that message, and I think they'll be very conscious of the market impact coming out of this one. But essentially, I think they're switching to a more flexible approach to their policy formation. They're going to back away a little bit from this extended commitment to maintain policy out to 2024. I think that'll disappear from commentary. But at the same time, trying to balance that against a commitment to still doing whatever is required to secure recovery. But there is another element to the policy picture at the moment that will also be coming into frame. We know the RBA has shifted its rhetoric around the housing market, and this week's numbers have again really underscored the extraordinary strength we're seeing in price gains. We also had credit data out for the month of May that showed housing credit growth now tracking at 4.8% a year, 6.8% on the last 3 months of an annualised pace. That's starting to get near the thresholds where RBA and APRA have moved on macroprudential policy in the past. So back in 2015 and 2017, one of the key thresholds was investor credit getting around about that 2% per annum pace. Now, the current momentum is still well short of that, but it was tracking towards that pace by about year end. So there may be some evolution in the rhetoric around housing markets as well. The complexion, though, is a little bit awkward. It's still really owner-occupiers that are driving things. If you look at that 3-month annualised pace, owner-occupier credit growth is running at over 8%. And investors are kind of sidelined. They're tracking about 4% as an annualised pace at the moment. So this situation around housing will be gaining their attention, but I think they're going to keep it really simple for next week's meeting. I think, given the context of a lockdown, it's just not appropriate to talk about tightening measures. So now we need to sort of stay the course on the stimulus, ensure that we get through this latest health restrictions, and we get back on track for our recovery.
Yeah, certainly a huge amount for the RBA to ponder there. So thanks very much, Matt, for discussing that and what else is going on in the economy. So thanks for your time. And thanks everyone for watching, and we'll speak to you soon.